Let's pull up Jindal Stainless as well. The metal sector has taken a hit in trade today. Jindal Stainless is on our radar, and on the phone line we have Anurag Mantri, the Group CFO at Jindal Stainless, joining us to give us a fine print of the quarter that has gone by. It is looking like a strong number. Strong volumes seem to be pushing up the top line for your company, sir. Do tell us what has worked for you in the quarter gone by. Mr. Mantri,
yeah, hi, good afternoon, Vikram and Fatima. So I'm happy that I think, yes, I am with you.
Go ahead, sir.
Can you hear me?
Yes, absolutely, Mr. Mantri. I was asking you what has really worked out for you in the quarter gone by. Can you hear me?
Yeah. Yes, I can hear you very well. In the last quarter, we had continued to attract a good growth momentum. So what we are seeing in a stainless steel, this being a more value-added metal and the fastest growing metal, it's replacing lots of other metals and substances in other applications. So we are seeing an increasing trend in automobile, railway and infrastructure side continue to drive the volume. And we being one of the most, in terms of our most modern plant, we are able to deliver those cost efficiencies and these volumes. So what we have seen is a good volume growth in the quarter on a year-on-year basis, and that is resulting in a good EBITDA as well as the PAT growth. So we have doubled the PAT during the quarter, and while our raw material continue to have a very volatile, and we have seen a spike in raw material prices like nickel, also some of the consumable prices like graphite electrode. So that has witnessed some of the margin pressure in terms of our EBITDA side, because not everything which we couldn't pass on to the customers. So you have seen a half basis point dip in the EBITDA margin percentage, which was 12.4 last year same quarter, and this quarter we had 11.9. But overall, in absolute term, because driven by the volume growth, we continue to track a good EBITDA and PAT growth.
Sure. Mr. Mantri, can you also give us some details as to the jumps we've seen in the interest costs, as well as if you were to tell us a little bit about the current debt equity and where you see it at the end of FY19?
Very good question, Fatima. So just to clarify, that interest cost is not like-to-like comparable in both the quarters. So if you see last year same quarter, we had a one-time interest refund of around 82 crore. So it's not really comparable number. So that's showing the larger jump in that. And this quarter also, in a ramp up to the production, we had some short-term impact on the higher working capital cost, but which was primarily it was because of the exceptional interest reversal which was booked in the previous quarters. In terms of debt equity, if you see, net debt to equity is now below 2, and the debt to EBITDA is now below 3. So long-term debt to EBITDA. So we are actually focusing a lot on not only the P&L side on our business, but we have focused completely on restructuring our balance sheet, and the ratios are now coming very well under control on a right side. And that our theme is not to have a further leverage, and deleveraging is the key theme for us. So that way net debt to EBITDA is now below 3 and debt to equity is below 2.
Right. Mr. Mantri, I also wanted to check with you about volumes. In the quarter gone by, the first quarter, has it met your internal expectations, and do you expect growth to continue?
See, we are running now near to the 100% capacity utilization, and but as we see that this is one of the most modern plant and state-of-art facilities. So with certain debottlenecking and through process balancing, we expect to increase the capacity utilization from 0.8 to 1.1 million during the financial year sometime. So that should take up our continue to have our growth momentum in terms of the volume side. But margin side, I see we managed to have a good tight cost efficiencies in line with the world-class plant. But I think what we are still seeing are the Chinese imports, which used to be a key problem some time back. We are seeing now the government has really done the right job in terms of putting up the CVD last year in September, as you recall. But what we are seeing is that now some of the Chinese materials are coming through the FTA, some of the FTA countries like Indonesia and Malaysia. So that continues to create, and those are underpriced imports. So we are perfectly okay in terms of the import from if it's on a level playing field. But I think these can put a pressure on the margin. So we continue to have a close watch in those. And what we expect is the government to take a right step in terms of people not circumventing the CVD provisions what they put it up last year, because this is creating a huge trade imbalance in overall FTA with the FTA countries, and that was really not the idea of creating these FTA. The other thing what we are seeing is that there is an inverted duty structure in our industry. So there is a 2.5% duty in ferronickel and stainless steel scrap, which is the key raw material for us, and which are completely not available in the country. So that actually does not create a level playing field as far as the other imports are concerned, because we have to import the raw material at the certain duty structure. So I think we expect eventually, and we are requesting government to correct the inverted duty structure. So that will help the Indian producers to have a right impact of the government Make in India initiative on the stainless steel sector.
All right, fair points there. Can you also elaborate on your capex plans for FY19?
So FY19, Fatima, as we mentioned, is that our current capacity is at 100% is around 0.8 million ton, and we expect to ramp up this capacity during this financial year to 1.1 million ton. Just through some of this does not require any of the new large capex, but it will be done through more debottlenecking and process balancing with a very minimal capex. So this is obviously to leverage on our huge operating leverage, which we have the very good facilities in Odisha. So we expect with very minimal capex of around 40-50 crore, we can actually ramp the capacity from 0.8 to 1.1 million ton during this financial year, and we are working towards it.
All right, Mr. Mantri, appreciate you joining us, giving us perspective on the numbers that have been reported for the first quarter, and indeed walking us through your capex plans as well going ahead from here. Growth seems positive, but you do need that support coming in from the government, like you pointed out as well. The stock, meanwhile, despite the stable first quarter that Jindal Stainless has posted, is down about 1.5%. We continue to track that counter and many others that we'll take up with our market guest. He's joining us on the other side of a break. We're going to put the focus on many sectors and many stocks that are catching our attention in trade today. Rahul Shah from MOSL is joining us in just a moment. We'll be back with him on Lunch Money in a moment. Don't go away. We'll be right back.